Today we are breaking down NIO's second quarter 2025 earnings results. And what's compelling about this report is that it tells two very different, almost contradictory stories. On one hand, you have record-setting operational growth. On the other, you have significant financial pressure building on the balance sheet. Our objective here is to dissect the data to understand the true state of the company.
So, what is the central tension in this report? Well, it's this exact paradox between record sales and risky finances. Our analysis suggests that to understand this, you really need to grasp three key points. First, the company's multi-brand strategy is succeeding in its primary goal, driving unprecedented sales volume. Second, this growth is coming at the direct expense of vehicle margins and overall profitability. And third, this has created a fragile financial situation, putting the company in a race against time.
So let's begin with the first part of that story, the impressive growth metrics that are fueling much of the narrative around the company right now.
From an operational perspective, the second quarter was a clear success. NIO delivered a record of just over 72,000 vehicles. That represents a powerful 71.2% increase quarter over quarter. Now, this surge isn't arbitrary. It is the direct, calculated result of launching and ramping up production for their new, more accessible sub-brands.
However, this is where the picture becomes more complex. All that record volume did not translate into meeting market expectations on the top or bottom line. Both revenue and earnings per share fell short of consensus. The primary reason for this divergence is a lower average selling price, which is the inevitable consequence of a sales mix that now includes a significant number of lower-priced vehicles.
And this leads us to the core profitability challenge, encapsulated by this number, a vehicle margin of 10.3%. The critical piece of context here is that this figure is actually down from 12.2% in the same period last year. So even as they are selling significantly more cars, the direct profit on each vehicle is contracting.
And just to be very clear on why this metric is so important, for any automaker, vehicle margin is a vital sign of the fundamental health of the business. It measures profitability at the most basic level, making and selling a car, before you account for corporate overhead like R&D or marketing. A declining margin, especially during a period of rising sales, is a major signal of a strategic shift.
So this begs the question, why are these margins shrinking? Well, this is not an accident. It is the direct outcome of a deliberate and, frankly, high-stakes strategic bet NIO is making on its multi-brand future. The data here illustrates the impact perfectly. The new, lower-priced ONVO and FIREFLY brands already account for over a third of total deliveries. This is a clear success in terms of capturing new market segments. But it is also the simple mathematical reason why the company's blended vehicle margin is being diluted.
From management's perspective, this is the strategy working as intended. In the earnings release, CEO Li Bin framed this as a positive, noting the strong market response has solidified their sales momentum. The objective was to drive volume, and by that measure, the plan is succeeding.
This really crystallizes the core trade-off at the heart of NIO's strategy. The company is consciously sacrificing higher short-term margins in a bid to achieve aggressive market penetration and long-term scale. The central, open question for the business is whether the economic benefits of that scale can eventually outpace the cost of this margin dilution.
And that brings us to the most critical part of this analysis, the company's underlying financial health. Can the balance sheet actually sustain the pressure of this volume over margin strategy?
A review of the balance sheet reveals clear signs of financial fragility. Total current liabilities now exceed total current assets, which creates a negative working capital position of nearly 10 billion yuan. This is a textbook indicator of short-term liquidity pressure.
And there are other factors compounding this pressure. The company is reporting negative shareholder equity. And on top of that, it posted a non-GAAP net loss for the quarter of 4.1 billion yuan. When you set that against cash reserves of 27.2 billion, you can see a significant quarterly cash burn. This combination of factors puts the company in a very real race against time.
Now, management has presented a clear counter-narrative to these concerns. The company's CFO, Kwa Yu, stated that they are approaching a structural turning point. The clear message here is that they view these challenging financial metrics as a temporary phase before a more sustainable, positive trend takes hold.
So, how do they plan to reach that turning point? Their strategy appears to rest on three key pillars. First, they've issued aggressive forward guidance for Q3, projecting continued strong delivery growth.
Second, they are emphasizing disciplined cost control. And indeed, R&D and SG&A expenses did decline quarter over quarter. And third is the core thesis, that achieving greater scale will ultimately improve efficiency, margins, and stabilize the company's cash flow.
Of course, none of this exists in a vacuum. Placing NIO's results in the competitive context is essential. And when you do, the profitability gap becomes stark. Key domestic rivals like Li Auto and Ceres are not only delivering more vehicles, but they are doing so with significantly higher margins and are posting substantial net profits. Even XPeng, which is also unprofitable, is currently reporting a stronger vehicle margin and a considerably smaller net loss.
So to bring this all together, the data paints a very clear picture of a company executing a high-risk, high-reward strategy. The success in driving volume with the new brands is undeniable, but this volume is coming at the direct cost of profitability, and it has created a fragile financial situation that makes the performance over the next few quarters absolutely critical.
This leaves us with the ultimate question. NIO is at a decisive inflection point. Is the structural turning point that management speaks of truly on the horizon, where scale and efficiency finally drive sustainable profits? Or do the current financial headwinds and intense competitive pressures signal the beginning of a much longer, more arduous path to profitability? The data from the coming quarters will be instrumental in answering that very question.